Aggarwal, Academic Counselor IGNU. Today we are going to study MMPC 14, Financial Management, Block 3, Financing Decisions, Unit 8, Financial Markets. A financial market is essentially a platform where financial assets are, traded between various participants, These markets are crucial for the proper allocation of resources in an economy. Traditionally, a market is considered a place where buyers and sellers meet to exchange, goods, services, or financial instruments. Financial markets differ from product and factor markets as they specifically deal with financial claims like stocks, bonds, and other instruments. These markets operate under defined rules and regulations that guide the process of financial transactions and ensure transparency and security for all participants involved. The main purpose of financial market is to connect individuals and entities with surplus funds, savers, with those in need of funds for productive use, borrowers or investors. Now, for example, the primary function of a bank is, accepting deposit for the purpose of, lending. If they accept deposits and if they don't, lend the money, the bank will not be in a position to, earn profit. Bank will have to close down. The funds which bank collects from depositors, bank has to pay interest to them. Same funds, bank uses for, giving loans, and bank charges, slightly higher rate of interest from the loan customers. The difference is bank's, profit. That is how bank runs. This channeling of funds promotes economic efficiency and productivity by ensuring that capital is used where it is, most needed. These markets facilitate trading in financial assets, thereby supporting investment, consumption, and overall economic growth. In essence, financial markets are fundamental to a country's financial system and are a prerequisite for economic development. Financial markets, perform several critical functions that contribute to a nation's development. One of their core roles is the efficient transfer of funds from surplus units to deficit units, collecting money from the people who have, surplus funds and giving loans to the people who are in need of, money. Surplus units are entities, individuals, they can be individuals X, Y, Z, then firms, proprietorship firm, partnership firm, then companies, private limited company, public limited company, or government bodies. All of, these people, they can invest that have excess income after consumption. Whatever they consume after that, whatever is, left, they are ready to invest. While deficit units are those who need additional funds for investments or expenditures exceeding their income. The movement of funds in the economy can happen in two primary ways: directly through financial markets or indirectly through financial intermediaries like banks. In direct finance, savers invest directly in financial assets. Saver will invest directly in the financial assets. Suppose you buy, shares, you buy bonds, In direct finance, savers invest directly in financial assets such as bonds and stocks. In indirect finance, financial institutions act as intermediaries, you see, pooling funds from savers and lending them to borrowers, like you see banks, you see. They accept deposits from the public for the purpose of lending. And why people invest in banks is because the money is very, very safe. Bank customers are going to get back their, you see, deposits. Principal value will never reduce, plus some interest also bank will give. The interest which bank gives is slightly less compared to, you see, if you invest privately with somebody or if you invest in companies. But there your money is not safe. But in bank your money is very much safe. Your principal will remain intact. Share market, if you invest 1 lakh rupees today, tomorrow it will become 90,000, then 80,000. You see, it can become 1 lakh 10,000 also. There is no doubt in it. But in bank, your principal will remain 1 lakh only, plus whatever is the rate of interest bank will give, you see, interest, you see, on as per that rate. That is why bank prefers, you see, that is why people prefer to invest in banks, post office, you see, and government securities, because their principal is, you see, same, and they are satisfied with whatever interest, you see, banks give. Role and functions of financial markets. Now, what are the roles and what are the functions of financial markets? Economic functions of financial markets include the facilitation of resource allocation from those who save to those who invest in, you see, productive activities. This leads to an increase in income and production, thereby enhancing national welfare. Financial markets also help savers, you see, earn interest or dividend, you see, income, while supporting, you see, business in generating revenue through, you see, borrowed funds. Suppose, you see, you invest in any Reliance, you see, company, they give Reliance shares, they give good dividend, you see. Financial functions of financial markets involve, you see, providing investment opportunities to units who are having surplus funds and enabling deficit, you see, units who are in need of funds to obtain funds for their activities. You see. Business can't run, you see, without money. These markets create liquidity by making financial assets easily, you see, tradable and convertible into cash. They also help investors, you see, maintain productive forms of wealth without owing physical assets. Other important functions include price discovery, liquidity provision, and reduction of, you see, transaction costs. Price discovery happens when the interaction of surplus and demand in financial markets determines the value of a financial asset. Liquidity ensures that investors can quickly, you see, sell assets without significant loss of value. Transaction costs, including time and search efforts, are, you see, minimized through organized financial markets. Types of financial markets. Financial markets in India are categorized based on the instruments traded, you see, which instruments are traded. So accordingly that, you see. Now, for example, foreign exchange, if then that is foreign exchange market, you see. stocks, shares, stock market. Then duration of maturity. What is the maturity of the asset, when it is going to mature, and level of organization. You see, proprietorship firm, partnership firm, companies, you see, big company, small company. Broadly, these are divided into organized markets. You see, organized markets are regulated by government agencies, you see, like share market, and unorganized markets. Unorganized market means operated by money lenders, those who give loans, etc., privately, and unorganized markets operated by money lenders and indigenous, you see, bankers. Based on maturity, financial, you see, markets are split into two major categories: money markets and capital market. And in capital market also, primary market, secondary market. If any new issue is, you see, coming, then first it will be sold in the primary market. Once the shares becomes old, they are sold in secondary market. These are further divided into primary and secondary market. Just now we saw. The money market deals with short-term financial instruments with maturities of up to 1 year. It is a wholesale market for instruments that are near substitutes for money and can be easily converted into cash. The key feature of the money market is its, you see, emphasis on credit worthiness and liquidity. It provides a mechanism for managing short-term, you see, liquidity needs of business, financial institutions and government. Suppose one bank is needing money for 1 day, for 2 days, you see, it will borrow from another bank. Similarly, if government needs, government can also, you see, borrow. In India, the money market consists of both organized and unorganized segments. So we are having organized markets as well as unorganized, you see, segments. Organized markets include, you see, commercial banks like State Bank of India. State Bank of India was nationalized long back. Then after that, in 1969, government nationalized 14 major commercial banks like Central Bank of India, Union Bank of India, Bank of India, Bank of Maharashtra, Punjab National Bank, Oriental Bank of Commerce, New Bank of India at that time. See. Then Allahabad Bank, United Bank of India, United Commercial Bank, then Indian Overseas Bank, Indian Bank, then Corporation Bank, Vijaya Bank, see, like this. And then after that, 5 more banks were, you see, nationalized. So there were total 19, you see, commercial banks which were nationalized by Government of India. And then later on, you see, these banks were, now these banks, you see, many of them are merged with, you see, other big banks, because computerization is there, so it is not difficult for them to run. They run the entire, you see, their bank plus merged bank. So now government also wants to, you see, merge the banks because expenses will be saved now. See, computerization is there, you see. So any number of accounts, bank can give service, there is no problem. Data management, there is no problem because of computerization. So in India, the money market consists of both organized and unorganized segments. Organized markets include commercial banks, financial institutions like SIDBI, IDBI, NABARD, Reserve Bank of India, Bankers Bank. While the unorganized segments include indigenous bankers and money lenders, particularly in the rural and semi-urban, you see, areas. In villages still, you see, people borrow from money lenders also. Major instruments in money market include treasury bills. Treasury bills, we call them T-bills. Then commercial paper, CP, certificate of deposit, CD, call and notice money, you see, and repo agreements. The RBI uses tools like, you see, open market operations, we call it OMO, cash reserve ratio, and repo rates to control liquidity and, you see, interest rates. Because RBI is, you see, bankers' bank, so it has to control the, you see, money, it has to control liquidity and interest rates, repo rates. The money market is essential for maintaining equilibrium between short-term fund supply and demand. It enables the RBI to influence liquidity in the economy and provides participants with efficient, you see, avenues to manage short-term cash, you see, needs. Capital market deals with long-term financial instruments such as, you see, stock and bonds. These markets, you see, enable companies and government to raise funds for infrastructure, expansion and development projects. Capital markets also allocate long-term capital to productive, you see, uses and promote entrepreneurship and economic growth. Suppose Reliance, you see, is promoting a new company, so it will collect the money from the people by selling shares. 10 rupees shares, say 2 rupees application, 2 rupees allotment, 3 rupees first call, 3 rupees second call. They can add some premium also if they want. And then people will fill the application form, submit that application form along with the check in the bank. After that, you see, all the applications, you see, which will be received by, you see, say Reliance, then they will, you see, do the allotment of shares. Now they see if the issue is fully subscribed or oversubscribed or 80% subscribed, you see, like that they will see. If it is oversubscribed, then proportionately they will give the shares to the people, they will do the allotment to the, you see, people. So capital markets deal with, you see, then they will collect first call and second call from the people to whom they have allotted the shares. So capital markets deal with long-term financial instruments such as stocks and bonds. Bonds, they will give you fixed interest, you see, in the beginning only they will tell you. If you make an investment with the company, they will issue a bond to you and, you see, they will pay fixed interest to you. These markets enable companies and governments to raise funds for infrastructure expansion and development projects. Capital markets help allocate long-term capital to productive uses and, you see, promote entrepreneurship and economic growth. The capital market is divided into two segments, the primary market and the secondary market. The primary market is where new securities are issued, often through initial public offerings, IPO. You must have heard, IPO is coming of, say, Hindustan Lever Limited or Reliance. It is example. The secondary market is where these securities are traded after their initial issuance. Once it is issued, then after that it will be sold in the, shares will be sold in the secondary market. Now everything is online, you see, by your computer or laptop or mobile phone, you can sell the shares, you can buy the shares. Functions of the capital market include, you see, efficient capital allocation, risk capital provision, price discovery, and increased investor participation. These markets also help in disseminating, you see, information, lowering transaction costs, and integrating various asset classes and markets. India's capital markets have evolved significantly and are now considered a benchmark by several, you see, developing countries. Next is you see equity market. Equity markets are you see platforms for trading shares that represent ownership in you see companies. Equity represents a claim on the residual income of the firm after all obligations are met. Share prices affect market you see expectations about a company's earnings, growth potential and risk profile. Equity markets help companies raise funds for business expansion and allow investors to gain ownership stakes and you see potential dividends. Suppose you have bought shares, now you are also one of the owner of the company and company will give you every year dividend on those shares. These markets also facilitate the transfer of ownership among investors and contribute to corporate governance through shareholder participation. So, equity markets are, you see, they help companies raise funds for business, you see, expansion and allow investor to gain ownership stakes and potential dividends. These markets also, you see, facilitate the transfer of ownership among investors and contribute to corporate governance through shareholder, you see, participation. Now, next is third one is debt market. Debt markets involve the issuance and trading of fixed income instruments, where income is fixed, 10% interest, 8% interest, 12% interest, such as bonds and debentures. See, companies borrowing by means of issuing the bonds and debentures, and fixed income they will give you every month. If you want interest will be served to you every month. These markets provide an overview. These markets provide an avenue for both the government and private entities to raise funds. Debt markets are crucial for long-term, you see, funding of development projects and financial stability. Debt markets help in resource mobilization, implementation of monetary, you see, policy, liquidity management and reduction of, you see, borrowing costs. The Indian debt market consists of several segments. Number one is government securities, G securities, risk-free instruments issued by RBI. There is no risk in buying these instruments. They are issued by RBI. Corporate bonds. Corporate means issued by companies to raise funds for, you see, operations and expansion. So Reliance, Hindustan Lever, all these companies, they will issue corporate bonds. And they will give periodically interest, and on the day of maturity they will give you your principal back. Your money is very safe. Then debentures, fixed interest instruments presenting a loan to the company. If you have purchased debentures, you see, then your interest is fixed only, how much interest company is going to give. Now bonds include zero coupon bonds, you see, convertible bonds, callable and, you see, putable, you see, bonds. Next is derivative market. Derivatives, you see, markets trade financial instruments whose value is derived from an underlying asset, such as stocks or commodities or currency. So, derivative markets trade financial instruments, any instrument whose value is derived from an underlying asset such as stock, commodity or currency. These instruments, you see, include towards futures, options and swaps. Derivatives help in managing, you see, financial risk due to fluctuations in, you see, place. Initially traded in, you see, over-the-counter markets, derivatives are now increasingly traded on organized exchanges that offer, you see, standardization, transparency and reduce counter, you see, party risk. These markets use a, you see, clearing house to guarantee trades and, you see, implement daily market to market, you see, settlements. Commodity market, you see, The commodities market facilitate the trading of physical goods, sugar, such as agriculture products, metals and energy products. So, what are traded in this commodities market? Agriculture products, metals and energy products. These markets help, producers and consumers hedge against, price volatility and promote price discovery. India has multiple regional commodity exchanges that deal in, items like gold, silver, crude oil and grains. With the advent of electronic, trading platforms, e-trading, electronic trading, commodity markets have become more, accessible and transparent, contributing to economic, development. Next is foreign exchange market. The dollars, buying of dollars. The foreign exchange market, the foreign exchange, forex markets deal with the trading of currencies, buying, selling of currencies. It is regulated again by RBI, Bankers Bank, and provides guidelines for transactions. Forex markets are, crucial for international trade and investments. Derivative instruments such as currency futures allow businesses to hedge against, currency fluctuations. Other markets, loan markets. Banks and institutions provide short-term, long-term loans. Which loans banks are providing? Education loan, then personal loan, housing loan, mortgage loan, then vehicle loan, these etc. Banks are, giving these loans. Now, most of these loans are very secured. Now, car loan, bank is doing, hypothecation of the car. You can't sell the car unless and until you pay off the loan. In the RTO, bank's name is written under hypothecation column. Then we come on housing loan. House is mortgage, So, housing loan is also very, safe. Mortgage loan means if you are having property and your daughter's marriage is there and you don't have money, you can take on your, home. You can take loan on your, property, but you should have regular income to pay the EMI. That you have to satisfy the bank. Bank will only give the loan, sanction the loan if you are in a position to service the EMI. And then next type of loan is mortgage loan, already having property and take loan on that. Personal loan, which can be used for any purpose. Mostly bank prefers to give to its, people who are having accounts in that particular branch, that branch will give loan. Now next is, insurance markets. Insurance, it provides risk. If suppose somebody dies, policy gets matured and the insurance company pays the money to the nominee. Now these days, this health insurance is also, there. So everybody should have, policy. If suppose, the person dies, family should get, money, some money. And such type of policies, yearly premium is there. There are so many advertisements. You pay 699 per month and take insurance of 1 crore rupees, like that. Some advertisement comes, So that is all they are mobilizing insurance, products. So everybody should have a, health insurance policy. That means, suppose you are sick, health insurance company will pay the money. Otherwise, your savings will go. Everybody should have some policy, like, if suppose, suddenly a person dies, his family should get some insurance money. These policies, they don't give you, there is no value when the maturity is there, but they cover the risk. If the person dies, they will give to the nominee 1 lakh rupees, 2 lakh rupees or 1 crore rupee, whatever is the policy amount. Now we have seen, loan markets. Now insurance markets, where insurance products are, sold. provide risk coverage and invest, you see, collected premiums in capital, you see, markets. Insurance company now they will do your insurance, their expenses are there. Now they collect money also from you, they will collect every month premium. So that money they further invest now. Otherwise, how it will run? If they will keep the money with them and sit idle on that, you see, then the company will have to close. So they further invest. Next is retirement savings markets, you see, include provident fund and pension funds. You see, that pool, you see, long-term savings. You see, in most of the government offices, pension is there. You see, after retirement, they will give you a fixed sum every month, same. Of course, whenever DA rises, they also increase little. Now, other markets are mutual fund markets where mutual funds are sold. Systematic investment plans, SIP, mutual fund, you see, they prefer that you should obtain a monthly SIP and invest your, you see, deposit amount will go every month from your account. Now, mutual funds allow small investors to assess professionally managed, you see, diversified portfolios. The next is, you see, savings and investment, you see, market. Other retail markets, you see, like fixed deposits and recurring deposits to households. Now, savings and investment markets offer retail products like, you see, fixed deposits. You can invest right from 7 days to, you see, 10 years in banks. And then recurring means every month you repeat, recur. You say you go to a bank and tell them, I want to open an account, a recurring deposit account. I will deposit every month 1,000 rupees for 12 months. So after 12 months, they will give you your principal plus interest, you see. This is a recurring deposit. Fixed, you see, in fixed deposit, interest can be serviced to you, interest can be paid at the time of maturity also. It depends on you. Whatever you will tell, you see, they will do accordingly. Now, participants in financial markets play a critical role in facilitating the smooth flow of funds from surplus to deficit sectors of the economy. These participants can be, you see, broadly categorized based on the segment they operate in, the money market or the capital market. Their participation not only supports liquidity and, you see, market functioning, but also ensures that savings are, you see, mobilized and channeled into productive, you see, investments. Now, in a bank, whatever, you see, they collect money from the depositors. That is, you see, they bank, same money is used as a loan. Participants in money markets. The money market comprises institutions and individuals who engage in short-term borrowing and lending. The participants operate, you see, based on varying interest rates, creditworthiness and maturities. The key players in this segment include commercial banks are there, financial institutions are there, individuals are there, central bank, the central bank of our country is Reserve Bank of India. The RBI is the apex monetary authority in India and most influential, you see, participant in the money market. It regulates money supply, interest rates and liquidity in the economy. The central bank acts as the banker to the government, manages public debt, issues currency, except rupee 1 notes which are issued by the government and coins, and maintains, you see, foreign exchange reserves. Through monetary tools like repo rate, reverse repo, open market, you see, operations, cash reserve ratio and statutory liquidity ratio, it directly influences the money market, you see, operations. Commercial banks, these are most active players in the money market. They accept deposits and lend money to businesses, households and other sectors. Their roles include, you see, providing short-term working capital through, you see, mechanism like overdrafts, cash credit and bill discounting. They also invest in, you see, money market instruments and act as intermediaries, you see, for various services such as collection of interest, dividends and portfolio management. So, this slide is about commercial banks. The role of a commercial bank is accept deposit for the purpose of lending. They accept money from the public and they give interest on that, and that money is used by them for, you see, giving loans. In loans they are charging slightly more rate of interest. The difference between deposit rate given to the public and, you see, interest charge on loans, that is, you see, the profit of the bank. So commercial banks are the most active players in the money market. They accept deposits and lend, you see, money to businesses, you see, households and other, you see, sectors. Their roles include, you see, providing short-term working capital through mechanisms like overdraft, cash credit and bill discounting. They also invest in money, you see, market instruments and act as intermediaries, you see, for various services such as collection of interest, dividend and, you see, portfolio management. So the functions of commercial bank is, you see, deposits. On the liability side is deposit, asset side is loans. Deposits comprise of, you see, savings bank account, current account, recurring deposit account, fixed deposit, you see, account. These are all, you see, deposits, etc., etc. And you see, on the asset side of the balance sheet are loans, you see, personal loan, education loan, car loan, housing loan. Housing loan is a long-term loan. It will last for 20 years, 30 years. Other loans you can take it for 3 years, demand loan, and or you can take it for 5 years. Then it will become term loan. The main thing is, you see, your repayment capacity should be such that you should not be a defaulter of any EMI. You see, bank, you see, selects that how much installments are to be given to that particular customer. And then now banks, commercial banks have started selling third-party products also, like mutual fund, insurance. Because these mutual fund companies gives the banks commission. They say that if a branch does 10 applications per day, we'll give them commission, say 100 rupees per application commission, 1000 rupees, you see. Now each commercial bank is having 5000 branches and each branch is selling, you see, third-party products like mutual fund, insurance policy, gold coins. So if the company gives the bank 100 rupees commission per application, say 10 applications one branch does, so total 5000 branches, 50,000 applications they have done, and if the commission is 5000 rupees per commission, you can imagine how much profit bank is making, and this profit is directly going to the profit and loss account of the bank, because bank has not made any investment in this. So commercial banks are the most active players in the money market. They accept deposits and lend money to business holds, households and other sectors. These include money lenders and indigenous bankers also, especially you see, prominent in rural and semi-urban areas. You see, in rural areas there are indigenous bankers and, you see, money lenders. Their operations are informal and mostly outside the regulatory framework of the RBI. They finance small business, artisans and other farmers. The lending is often on the basis of, you see, personal trust, and interest rate are generally high due to informal terms and flexible operations. Discount houses, these institutions provide liquidity by discounting trade bills. Bills are discounted. They play dual role, discounting bills for traders and rediscounting them with commercial banks. They also invest in short-term government securities and help banks adjust their cash positions efficiently. Though not prominent in India, discount houses are valid in, you see, developed, you see, financial systems like the United Kingdom. Acceptance houses, though rare in India, acceptance houses exist in advanced economies. They accept bills drawn on you see them provide trade financing and other advisory services related to shipping, insurance and credit regulation. They increase liquidity in the market by facilitating bill discounting through endorsement. Participants in capital markets involve a large and more diverse group of institutions. These participants may provide finance directly or offer services that support investment and trading in long-term financial instruments. Banking institutions, commercial banks, apart from their money market role, commercial banks are involved in long-term lending in the capital market. They accept fixed deposits, provide loans for purchasing vehicles, durable goods and housing. They also support businesses of all scales and provide loans for project financing, infrastructure and working capital. Cooperative banks and land development banks, these banks cater to specific sectors such as agriculture and small scale industries. Cooperative banks provide short term to medium term finance to farmers and artisans, while land development banks support long term financing for agriculture improvements and land development. NBFC, non-banking financial company like Muthoot, they can't open a savings bank account, they can't open a current account, but they can give loan on your gold. They will give loan. They accept deposits also, not like savings for 1 year, for 2 years, like that. Primary functioning in developed economies like the USA, investment banks help channel houses savings into businesses. Their their function include underwriting, advisory services, assisting in capital formation and secondary market trading and secondary market. In India, some functions of investment banks are carried out by merchant banks also. Merchant banks provide financial advisory services especially to corporate clients. Their services include corporate counseling, advising diversification, growth and restructuring, project counseling, preparing feasibility studies and financial projections. They see whether this particular project is economically viable and technically feasible. Bank also sees the same. If it is economically viable and technically feasible, bank will provide finance. Project counseling, responding to feasibility studies and financial projections, capital restructuring, advising on debt equity ratio. Debt equity ratio means whatever is the debt divided by equity. Suppose your debt is 3 times than your equity, it is 3:1. Reserve capitalization and asset utilization. Merchant banks, issue management, managing public issues of shares and bonds, including regulatory approvals and investor services. Portfolio management, advising clients on investment mix based on risk return profile. Credit system and working capital finance, arranging loans and bridge finance. Bridge finance means suppose your loan is under consideration in some bank. Now in between, if you need money some urgently, so you can go to any NBFC and you can take money from them and you can tell them that after 3 months my loan will be disbursed. Bank will pay to you directly. Then corporate restructuring, facilitating mergers, acquisitions and amalgamations. Then investment companies, these institutions pool funds from the public through instruments like units, shares and debentures and invest them in securities. They can be categorized as management investment companies, operate closed or open-ended funds with the discretion over portfolio decisions. Unit trust established under specific acts, they offer open-ended schemes like the Unit Trust of India, allowing investors to redeem their units anytime. Insurance companies, they sell insurance products with access to long-term premium income. Insurance companies invest in government securities and corporate bonds. Life insurance firms are, dominant due to long, policy duration. Their investments are, regulated to ensure solvency and protect policyholders. General insurance firms also, participate in capital market using funds from non-life, policies. Then development banks established post-World War II. These institutions finance, industrial and infrastructure projects in India. Key development banks include IFCI, SIDBI, SFC, SIDCS. Originally developmental in nature, some like IDBI and ICICI later transformed into, universal banks. They became banks later on, like Axis Bank. Earlier it was Unit Trust of India. These banks provide, long-term funding for economic growth. Then pension funds, when you retire, you get every month pension, and during your service they deduct every month, some amount of PF, and they will, return back to you at the time of retirement. These funds, pension funds, collect, long-term contribution from employees and employers and invest them in capital markets. Since payouts begin only at retirement, these funds have a long investment horizon and are major players in capital markets globally, Then private sector finance companies. These companies, raise funds through shares, debentures and intercorporate deposits and lend them as short-term business credit. They often, cater to niche borrowers and compete with commercial banks. Their dual role in, both money and capital markets, makes them critical to financial systems, integration. Now, financial markets are, indispensable to any economy as they facilitate the exchange of financial instruments and efficient allocation of resources. These markets bridge the gap between surplus and deficit units, ensuring that savings are, channeled into, productive investments. Like, a person, Mr. A is in need of money, Mr. B is ready to give him, but Mr. B is having surplus money, but B will not give it to A because he is not having faith in A. He thinks that he will not return. So B will deposit the money in the bank, and if A is in need of money, A can borrow the money from the bank. So bank in this case is doing intermediary, work. So financial markets are indispensable to any economy as they facilitate the exchange of financial instruments and efficient allocation of resources. These markets bridge the gap between surplus and deficit units, ensuring that savings are channeled into productive, investments. Financial markets are broadly divided into money market, short term, and capital markets, long term, and they include a wide variety of, specialized sub markets such as derivatives market, commodities market and foreign exchange market. Participants in these markets, range from central banks, Reserve Bank of India, commercial banks and cooperative institutions to merchant banks, investment companies, mutual funds, insurance, companies, development banks, pension funds and private finance firms. Each type of participation contributes to the structure, stability and growth of financial, ecosystem in India. In unique ways. Efficient financial markets promote, transparency, liquidity, price discovery and economic development. India's financial markets, especially the capital market segment, have evolved significantly and serve as a model for other development, nations. Now Unit 9, Financial Services. Financial services constitute a critical, component of the financial system. They encompass a broad range of activities and services offered by financial institutions and intermediaries that facilitate the flow of funds in the economy. These services help in mobilizing savings, promoting investments, transferring risk and facilitating economic growth. In simpler terms, financial services refer to the mechanisms through which financial institutions, you see, such as banks, insurance companies, mutual funds and investment, you see, companies support individuals, businesses and governments, you see, managing their, you see, finances. In India, the financial services sector has undergone tremendous transformation since the 1990s due to liberalization, privatization and globalization. The advent of new technologies, increasing competition and regulatory reforms have made the Indian financial sector more dynamic and efficient. The Reserve Bank of India, the Securities and Exchange Board of India and other regulatory bodies have played a pivotal role in this, you see, evolution. Financial services refer to economic services provided by the finance industry, which encompasses a wide range of businesses that manage money. These services include banking, insurance, investment management, leasing, factoring, venture capital and more. Financial services are delivered by financial intermediaries who act as the link between those who save and those who need, you see, funds. Meaning and scope of financial services. The scope of financial services is vast and includes mobilization and allocation of savings, promotion of investment activities, facilitating credit flow and liquidity, management of risk and uncertainties, financial planning and advisory services. The main objective of financial services is to ensure efficient and effective management of money. They serve the dual purpose of, you see, offering returns to savers and supplying necessary funds to investors. They also play a critical role in fostering economic development by improving the productivity of capital and increasing, you see, innovation and entrepreneurship. Characteristics of financial services, you see, intangibility. Financial services are, you see, abstract and cannot be physically touched or possessed. They represent a promise or potential benefit and are often delivered as contractual agreement between institutions and clients. Inseparability, the production and consumption of financial services, you see, occur simultaneously. For example, a loan service is delivered at the same time it is approved and disbursed. Disbursed means given. Perishability, financial services cannot be stored or inventorized. A missed opportunity to sell an insurance policy or loan service today is lost forever. Heterogeneity, you see, financial services are highly customized depending on client needs, credit policies, risk appetite and objectives. Hence they vary from client to client. Customer participation. Financial services often, you see, require active, you see, involvement from the customer, whether in providing information, documentation or decision making. Highly regulated due to their importance and systematic risk. Financial services are governed by strict regulations. Regulatory bodies like RBI, SEBI, IRDA and IRDA, you see, ensure compliance and, you see, protect public interest. Classification of financial services. Financial services can be, you see, classified into two categories: fund-based financial services, non-fund based, you see, financial services. Fund based, where the bank is parting away with the fund, bank is giving fund. Non-fund based, where bank is not parting away with the fund, say bank is issuing a guarantee. Non-fund based service will become fund based later on if it is invoked, if the, you see, guarantee, the purpose on whose behalf guarantee is issued, you see, does not comply. Fund based, you see, financial services, you see, these services involve direct deployment of funds by financial institutions. Key examples are leasing, a contractual agreement where the owner lessor allows another party lessee to use an asset for a specified period in exchange for, you see, periodic payments. Then there is hire purchase, then bill discounting, then there is factoring, then venture capital, then housing finance. Non-fund financial services are merchant banking, credit rating, stock banking, custodian services, mutual funds, insurance services, portfolio management, services, then economic liberalization and deregulation. Growth of financial services in India are technological advancements, then changing customer expectations, then regulatory reforms, then globalization, then innovative products and services. Now, challenges facing the financial service sector today are regulatory complexity, risk management, financial inclusion, technology of adoption, trust deficit, then talent shortage, then economic, availability. Now, in this particular chapter we have studied, financial, services. In this we have, seen fund-based services. Fund-based services are these services involve direct development of funds by the, financial institution. Examples are leasing, a contractual agreement where the owner lessor allows another party lessee to use an asset for a specified period in exchange for periodic payments. Rent, hire purchase, the buyer takes possession of an asset and pays in installments. Ownership is transferred only after the final payment. For example, on a hire purchase you have taken any asset, you will pay the EMI every month, and then later on it will be transferred. Once the loan is paid, it will be transferred in your name. Bill discounting, you go to the bank and take bills that I want money just now. So bank will discount those bills. On the due date, bank will collect from the, drawee who has to make the payment. So banks purchases bills of exchange at a discount before their maturity to provide liquidity to businesses. Then factoring, a financial service where business sell their, accounts receivable at a discount to improve, cash flow. Venture capital, it is funding provided to startup and, early stage businesses with, high growth potential in exchange for equity. Then housing finance, loans for buying a house, loans provided to individuals or groups for purchasing, constructing, renovating, residential properties. Now, non-fund based is, merchant banking services like issue management, corporate restructuring and advisory functions for funding mergers and acquisition. Then credit rating and evaluation of a borrower's creditworthiness expressed in ratings like AAA, BBB, etc. by rating agencies. Stock broking, acting as intermediaries between investors and stock exchanges for buying and selling securities. Then custodian, services, safekeeping of physical and electronic financial assets like shares, bonds and mutual funds units. Mutual funds, collective investment schemes that pool funds from investors and invest in different portfolio of securities like systematic investment plan, SIPs every month. The insurance services, protection against financial risks through life and general insurance, policies. Then portfolio management, professional management of individual or institutional investment based on specified, goals. Now, growth of financial services in India is, economic liberalization, deregulation, then technology advancements, changing customer, expectations, regulatory reforms, then globalization, innovative, products and services. Then we saw challenges, are regulatory complexity, risk management, then financial inclusion, then technology, adoption, then trust deficit, then talent shortage, then economic viability. Then we have seen the summary. Financial services are the lifeblood of a modern economy. They enable individuals, businesses and governments to mobilize resource, manage risks, invest productively and plan for the future. The Indian financial services industry has evolved considerably, offering a wide range of fund-based and non-fund-based services such as leasing, venture capital, mutual funds, insurance, and you see merchant banking. So students, we are this growth has been driven by liberalization, technological advancements, rising you see financial literacy, and sportive regulatory framework. However, to sustain this you see momentum, the sector must overcome key challenges such as regulatory overlaps, financial exclusion, operational risk, and skill shortages. Ultimately, a vibrant, inclusive, and well-regulated financial services sector is vital for India's economic transformation and long-term, you see, prosperity. So, in this particular, you see, unit, we saw financial services. You see, we studied, you see, commercial banks also, and we concentrated on, you see, our country. So we are closing down the session. This is the summary. So thank you very much, students. Thank you very much.